So yeah, thanks a lot for inviting me today, Max. It's really great to see learning communities like these springing up. I think they're really important in this field where there are not that many of us and we're all spread out all over the world. A significant amount of progress that I've made this year has come down to learning communities like these and the conversations and connections that I'm making in these forums. So kudos to all of you for co-creating this all together. So offering you a little guidance about today's presentation. This is totally planned and not improvised, and I have a good deal of content to talk through. So the delivery is going to be much more in the style of, yes, sage on a stage, which I know Max normally discourages, but I really can't help myself here. I love doing this. And as I said earlier, we will open up at the end for questions and discussion. If you have questions for points of clarification during the presentation, raise them in the chat. Maybe Max can interrupt me or something, but really just make those about points of clarification. Please save open-ended questions to the very end. And okay, let's see what we've got. Yes, I have to promote myself. You can find me on LinkedIn. I have a YouTube channel as well called Token Design. You can follow me there as well. And drumroll, I have a teaching course teaching tokenomics, modeling for fundraising and new listings. It comes with a professional grade spreadsheet tool, and really happy to offer you a 30% off coupon that you can see there. It'll be valid for a month. So, okay, that's me finished with my commercial plugs. I could move on with a lecture, but I think I should say a little bit more about myself to explain the perspective and experience that informs the ideas I want to share with you today. So I only made it into blockchain in 2020. I'm not one of those people who says I was there in 2013. I was a skeptic. And I initially started work helping out blockchain projects to help raise capital, and then increasingly to create some of their economic designs and strong utility narratives around their tokens. The skills that initially broke me into this field was the understanding of finance that I developed in my earlier career, and the advanced modeling skills that I'd cultivated while working there. Now, essentially, what a financial model does is it creates a forecast for the activities of a business entity of interest, and it expresses that forecast as a complete set of financial accounts for that entity that fully respect all the rules and definitions of accounting that are involved. Now, you're taught accounting as a finance professional because it's still deemed to be the best, most comprehensive language that we have to analyze business activity in general. Where I think this informs my approach to tokenomic analysis and some of the ideas that I'm going to share today is that I bring an accountant's skepticism to these problems. I don't mean that I spend my time creating financial accounts for blockchain systems. What I mean is that I'm skeptical about any vague or fantastical claims about value, and instead strive to describe economic processes, breaking them down into a set of clear, countable parts that have known relationships to each other and can be reconciled with each other. I do also have earlier university training in economics, which has found massive renewed value for me since I started going deep into tokenomics. But I think it's probably the accounting instinct I just mentioned as more to answer for in shaping the ideas for today's talk. So that's me, slides over. This is where I'm coming from in terms of my experience. And I think this also starts giving you a flavor of my teaching style. But just in case we need to clarify anything, yes, it's going to be a theory lecture. This is going to be very heavy on that. And I have tuned into some of their sessions. I know that some of you prefer presentations to be more applied and concrete. However, in my defense, I do think that my approach to theory tries to keep the practical consequences in view. So maybe don't rush to turn this off, even if you're avowedly theory averse. But let me go beyond that, actually, and make a positive appeal for the importance of theory in the current state of our industry. Lots of money was raised during the pandemic boom, and many of those businesses, including ones that were well-intentioned and not just fronts for fraud, are no longer operating. Now, we can blame the enormous collapses triggered by Terra, Celsius, and FTX, or maybe we could look inside and ask ourselves whether we actually have any clue what we're up to. In that space of deeper reflection, theory becomes a guiding light, because having a more substantively developed theory can give us a means of thinking critically about, the latest fads in our sector, rather than just aping in and hoping for the best each and every time. Anyway, that's my philosophical preamble over. Let's talk demand, utility, and demand-sided mechanisms. And let's start with an important question. Why is demand so hard for blockchain? The fact that we're having a lecture on demand in the first place is kind of weird. Normally, when we design new products, the utility and the demand of that product is self-evident. If you watch a show in the style of Shark Tank or Dragon's Den, you never hear the investors say, great product. Now, how are you going to find demand for it? No, they just say, great product. If the founder has a good idea and they've pitched it well, the usefulness is there for everybody to see, so much so that we can create mass market entertainment from this. So why is it difficult for blockchain? And, it's like we're questing after demand as if it were this legendary stuff out there. Why is it so difficult for us? Well, I think it's down to the financial liquidity of the tokens that are the interactive centerpieces of our systems. The incredible promise and appeal of being able to exchange anything for anything at low cost automatically is at once both a defining strong point and the Achilles heel of our blockchain efforts, because the same features also enable financial speculation. Now, speculation is tricky to define, but for this presentation, let's call it a play to buy the token simply to be able to sell it on to someone else at a profit, who in turn has exactly the same motivation to sell it on to someone else, because, and so on, right? There's always a greater fool, as they say. But speculation is just one kind of behavior that people can engage in. It's one motivation for buying and selling tokens. And people could have all kinds of motivations. But the thing is, digital asset markets are open, unregulated, and deeply permissionless. So anybody can come in and do whatever they want. And because transformational riches are such a visible part of the crypto story, speculation has proven itself to be the main attraction and the main force in these markets. So what's the problem? Well, speculation has been damaging. It's been terribly destructive. Years of savings are wiped out. Whoops. Companies go bankrupt. Sorry, I'm flicking the wheel there. And of course, lots of other companies get caught in that fallout. And this isn't a video game or a piece of software that I can patch up and everybody gets back to using it, playing as if nothing happened. The damage is real and lasting. So in my view, the fact that genuine utility and damaging speculation are so deeply connected at the core of by these blockchain features, and together with the fact that smart contracts can entangle these two things in even more complicated ways now, motivates an analytical approach that treats speculation and utility as if they were two distinct and completely separable things. We need to be ruthless in saying whether something's either used for speculation or intended for speculation, or whether it's intended to be used for utility. Okay, right. I think I got my notes mixed up. So this is sorry, I think I messed up my notes here. We have this entangled mess. They are deeply connected. So in order to create a good analysis, a strong analysis, I suggest to you that we start out that as if these two things were completely, cleanly separable. How do we define these? Well, speculation, we could say, is buying to sell to the greater fool, as I said earlier. And utility can be everything else. I'm only half joking there. We'll dig deeper into what utility is in a minute, but I want to show you that a definition for speculation by itself can already be useful. Okay, if you look at a project and all of its features and merits are only of speculative benefit, then that could be enough to say case closed. And this is a purely speculative project, and if you're interested in utility, you can move on. I think the original version of SafeMoon is a good example here. This token was launched and promises were made to do something with it someday, or the funds raised or something. But the heavily marketed features of the token was that anytime somebody would sell it, a share of that sale, a portion of that sale, would be burned, and another portion would be locked up in the DEX, and then a smaller portion would be recycled back to the people who didn't sell. So what happens over time? Circulating supply goes down, price goes up, and presto, it's a safe moon, or so they said. So that's this is what actually happened. Now, putting a bunch of other red flags about this project to one side, if we look at the features in the way that I just suggested, being super strict about saying, is this utility or is this speculation? There's absolutely nothing in this project other than a mechanism to create an instrument for speculation, where still the mechanism serves to attract and amplify speculation. So if you want to get involved on that basis, fine, but don't let the existence of anything else here fool you into thinking that we're dealing with any other kind of utility. Okay, so let's suppose we're looking at a different project now, and we found some utility. It's there. So that's great. Now, you might think that our next task is to go and look deeper at this utility and understand it. But actually, I say, hold on, wait a minute. We're actually not done with speculation yet, because speculation isn't something that goes away. And we now have some more complicated questions to address. As long as blockchain economies are connected to open, free markets, speculation is always going to be a thing. And that means that just saying that there is utility or some non-speculative case for demand isn't enough. We also need to now look at how resilient that utility is in the face of speculative pressure. What are some touch points for risk analysis here? Well, what share of demand is focused on speculation and extraction versus utility? How might that change over time? How would changes in token price affect the underlying economic activity that's aimed at supporting utility? Are there any feedback loops that would amplify these speculative effects, taking the system past dangerous bounds? Are there any mechanisms created to mitigate any of this? How effective are they? An example where an analysis between the interplay of fundamental and speculative demand would have been helpful is Axie Infinity. Now, ostensibly, Axie had a game that you could play, and it's very colorful. Look at those squidgy things. And that obviously is a case for sustainable, non-speculative utility. Well, is it sustainable? A lot of us thought that the fact that it had a game was enough and just aped in. But by doing that, we missed out on an examination of how the game's reward mechanics would play out in the hands of extraction-motivated actors, or similar to speculators, and how that would affect the experiences and incentives for players who are less aggressively focused on its extraction. So this wasn't sustainable. It wasn't enough just to have utility. We have to look at the interplay of these two forces as well. Okay, so let's pause for a recap. What have we got so far in this quest to analyze demand? Well, we check for see if there's any non-speculative utility, and then we check if it's resilient, if it can withstand speculation and other market shocks, I think. The next step then is to understand the economy that creates this utility. If we don't understand it well enough, we'll fail to understand the way this project is catering to some kind of demand. Now, I'm laying these out step by step to kind of distinguish between different tasks, but in practice, what you find is that all of these are going to sort of cross over and inform each other, and you're going to have to sort of address the problem in a holistic way. Our understanding of the economy will help us understand whether it's resilient to market speculation. But, you know, just for this presentation, I'm just separating it out and making a bit of a story as we go. So for step 3, we're now going to examine the underlying process that generates utility for our economy. And that confronts us with a fascinating question. What is utility? So this could be a long conversation to enjoy with some wine or some magic mushrooms. But when we don't have time for that, I tend to remind people of saying that environmentalists say, you can't eat money. Now, well, guess what? Hey, you can't eat tokens either. I think this saying has a very important insight for us, that tokens are never, and it can never be, intrinsically valuable as long as we're human and we don't get some kind of like pleasure fix from reading a wallet address or something. Tokens are not valuable. They're not in themselves. What users are actually valuing is something that the tokens are deriving their value from. And you can find this idea implied by another statement that you often hear people say when they are introducing newbies to crypto. And that's the one that says that tokens are representations of value. But okay, we've just pushed the can down the road. If tokens are not intrinsically valuable, then what gives them value? What imparts value to them? Or put another way, what value do tokens represent? Well, as far as I can make out, we're generally talking about one of two situations, right? Tokens either grant us a claim on some other asset, or they gate some access to some kind of market. Let's unpack this, starting with the claims case first. Now, maybe I should clarify that I'm not talking about claims in a strict legal sense, but a claim in a sense that's just economically effective. I have this claim on this, and I'll be able to redeem and fulfill that claim. Arguably, it is that effective economic outcome that the legal concept was invented to protect and secure. Now, the most common example of this claim-based value is a claim on other digital assets. That's common and easy because we can design and enforce them at low cost with smart contract technology. We could also have claim to gameplay content and experience, access to governance rights. With the rise of real-world assets, we may be talking about claims on physical assets like tokenized whiskey. We may also have tokens that offer claims on intangible assets like social status, prestige, which underpin the value case of a lot of NFTs. the standing of these value claims are not all created equal. Some things to look out here are how many assets do our tokens give claim to, one or many? How correlated are the value of those assets to each other and with the broader crypto market? Terra fell because its value support was entirely correlated with itself. There was a play-to-earn project called Stepin, which offered people in-game NFTs with their tokens, which were valuable when the project was doing well, but no longer valuable when the project was not doing well. So the asset was highly correlated, and so it ended up being valueless anyway once the market went south. What's the process that generates or supplies these underlying assets that are being claimed? How does that scale? How resilient is that? And how reliable is the redemption process as well? This is similar to you going to the bank, handing in your IOU, and you actually getting gold back. If they sort of say, "Oh, sorry, we run out of gold today," what's that gonna do? Are there any frictions there that we need to understand? Let's look at the second one, access to a market. Now, I could have folded this into the claims idea that we were just looking at, but I think doing that doesn't really give us any advantages. So let's just think of it as access to a market, tokens allowing us access to a market in some cases, or giving us privileges, maybe discounted use of that market. What are the kinds of markets we could get access to? Well, smart contracts allow us to enter into new kinds of economic agreements, right? In principle, so and that is sort of opening up another market. Suddenly, two people who couldn't do business with each other in some sense now can. So that's very similar to a market. We can also create new market rules, new ways. These are now secured cryptographically, and it's really interesting because we think strategically. If a rule can't be broken, and we know that rules can't be broken, that in some certain situations changes the way that people behave in a market and can be an important contribution to that market delivering better economic outcomes for everybody. We might be able to open up markets to previously inaccessible investment classes like rare whiskey. And they get, new capital markets open to them by investors who, have smaller amounts of capital to invest. Of course, we also have exchanges, NFT marketplaces, in-game markets, all that take place in these virtual worlds, social clubs, and markets for computational capacity or activity of some kind. These are all utilities, right? We don't need to go deep into the hard philosophy of utility to know what things that are useful. But how we determine the amount of value that we have in these markets can be really complicated to analyze, okay? I think we still need to take into account the production economics of the assets that are being brought to these markets, like we were doing when we were looking at the claims bit. But we also have to consider that the value accessible in these markets depends on who else shows up, and who else shows up from your side and from the other side and any other sides that are taking part in this market. Certain market situations may also need game theoretic analysis to understand possible conflicts of interest and strategic behaviors that may worsen outcomes in that market. And in addition to all this complexity, it's also just really tricky. It's not possible really to generalize what the positive factors are, because that will depend on specifics of a market. The things that are going to make a dating market really good are not the same things that are going to make a distributed storage market successful. Okay, these things are really specific, and there's a fascinating literature which is interesting to read, because it's all about success in these businesses is all about understanding your market and all these specific factors. What we can say at a high level is that these markets are made better when they enable higher quality matching that's reliable, fast, fair, and safe. Okay, another interesting question to keep in our minds as we do all of this is to ask ourselves, does blockchain make any difference here? Okay, does it contribute to the underlying utility in some way? Does it have some advantage, or is it essential for these products in some kind of way? Or is it just a gimmick, incidental? Blockchain can add value through the openness, composability, and interoperability of this shared economic platform. Or it may secure innovative smart contract designs or market rules that truly can't be broken by anybody. So it may be playing a role at a deep level here. Now, if blockchain is supporting your product or utility in these deeper ways, I think that really does strengthen your demand case in important ways. It makes it likelier that people are going to put up with all the bad inconveniences of interacting with blockchain networks, and that your product's going to be less likely to be threatened by off-chain competitors. But at the same time, actually, I don't think that this is a deal breaker if you're not using blockchain in these in these stronger ways, especially as we see more and more economic activity move on chain, and UX gets better at making blockchain disappear into the back end. And you know, the dApps of the future, we won't even know we're doing things on blockchain. The mistake to watch out for in this area, though, is just you know, avoid being tricked into thinking that just because a project happens on a blockchain, that's going to make up for what's otherwise a crappy idea. Okay, so what do we got? So all that discussion got kicked off by step 3, which is about identifying the underlying utility being offered and understanding the economic process that stands behind it. And the way I've been talking about that sort of emphasizes, suggests that we should be able to end up with a structural analysis of this economy, right? And that should allow us to create flowcharts and system maps like the ones you see coming up and now. These are often critical diagrams in project white papers and not easy things to put together either, I might add. But some of you might still object that this doesn't go far enough, because in order for us to be able to analyze demand in a way that is specific and truly practical, we need to have things that we can measure and track. Well, I agree. And that's why step 4 is all about doing that, identifying key activity and performance metrics for our economic process. But if the goal of that is also to understand the economics of our utility, why don't we just all do it in one step in step 3? Well, I think it's really valuable to think about the structure of the economy as a separate step, because if we don't have a clear view of that structure of the processes at work, how they interrelate, I don't think we will have a clear idea of what it's worth our while to measure, or what it's even possible to measure in the first place. The range of economic applications and processes that are going to be handled on-chain are just too diverse for there to be one set of measures that you can reapply every single time. But at the same time, I don't think we'll be reinventing the wheel every single time here. You know, a lot of things we do on blockchains are going to resemble things that we already do, or just be sort of extensions of them. And then, you know, if that's the case, we can use lots of established metrics that are already, you know, developed have been used for decades to give insight and to help us manage conventional businesses. You know, I consider these metrics that are commonly used for software as a service startups. Customer acquisition cost, how much you pay to acquire a new customer. Lifetime value, how much value does a new customer bring in over the lifetime? Monthly recurring revenue. Average revenue per user. Churn, the percent of the user base that's leaving. Yeah. Are these from another planet? No. They're entirely sensible metrics that we could probably apply to helping us understand a lot of blockchain projects better at a fundamental level. An important caveat to add to that, though, is what to do when we need to track intangible value. Things like when we're talking about projects that tokenize intangible social assets like prestige and status. I argue that in these situations, we need to do the best we can and find proxy metrics, whether that's indicators of the socioeconomic status of our community or some measure of their engagement levels. I don't really know. Again, it probably won't generalize between different projects, but if we give up on trying to track anything at all, I think that will leave us worse off on the whole. Okay, so I've now said a lot about underlying value, how we might understand it, structure it, measure it. But if you think about it, what happened to token utility? Okay, we started out this journey assuming with the assumption, a helpful assumption, taking tokens and underlying value to be completely separate things. And from there, we've just been focused on the underlying value. We haven't said anything clearly about tokens yet. Okay, so let's bring in step 5, creating mechanics for our token utility. To get to token utility proper, we need to create mechanisms that link the underlying economic processes to the tokens directly. It's that role or connection of the tokens to the economic process, which imparts some kind of fundamental role or value or utility to them. And I would argue that doing that well, again, requires us to have this rich and detailed picture of the economy, of the underlying economy that we've been going through so much effort to develop. So it's really quite simple. You just find a place where it plugs in, one of the many linkages, one of the many flows. It just has to play a role there, and it has to be a necessary and indispensable part of that economy in order for agents to benefit from it. And in the majority of cases, actually, though, the actual mechanisms that allow us to do this are really limited, because in the most basic case, there are just two things that you can do with user tokens. Users can either just choose to hold them or transfer them. Okay, these are the only two actions that we can ethically plan for. Okay, because the tokens are now in the user's hands. They have to choose what to do with them. We can't design self-exploding tokens, because, I mean, we can. I'm sure that will happen in some games. But that, remember, Bitcoin got invented because people wanted to have control over their assets, not have strange or random things happen to them. So it's quite striking that, you know, fundamentally, these are the only two things that we can plan to happen with tokens. Obviously, we don't leave the power to mint tokens in the hands of users, because you know, it's bad enough when it's in the hands of developers. So if we limit ourselves to these, you know, two basic voluntary actions that we can ethically use, well, what are the things we can do with these things? So, this set of options isn't that varied either, although depending on how much complex logic is tucked into smart contracts and networks of smart contracts, I suppose the actions could end up becoming quite rich or sophisticated. But for the time being, generally, we can either, you know, the transfer tokens either are transferred permanently in exchange with an independent agent, or with a system-aligned agent that can be a human or a protocol that acts in a way that aims to further the goals of the system, whether that's refunding the treasury, whether that's keeping levels balanced in some way. We've got staking, where the exchange is one where the user puts their tokens away so that they can't be used for anything else immediately. Typically, we see locks being applied to that, and the unlock may be contingent on. It's usually time contingent. It might be event contingent. And then we've got burning. So these are things we can do with the transfers. And the key questions we should be asking is, what fundamental economic action does this link to in our system? Who ends up with the tokens afterwards? What are their interests and what can they do with these tokens? How does circulating supply change now or later? And how does that change in relation to the value? So what STEPN will do is when if you go use their tokens to buy a real world concert ticket, the tokens are burned. And that makes sense because in some sense, the ticket is one thing that was in the network, and then it's being taken out by a user, so it can no longer be used by another network. Basic monetary principles suggest that, the value is being destroyed, so tokens represent value. The tokens should be destroyed as well. If you have a treasury that's trustworthy, it's kind of giving them back to the treasury is kind of like destroying them because they're no longer in circulation, and then the treasury then has the discretion to conduct monetary policy at a later time. So there are all these things to think about, right? So how does the token supply relate not just to the stock of value, but the rate at which value is accessed in your economic process? Dun, dun, dun. Just reading over my notes. Yeah. Okay, and again, SafeMoon, easy target here, but those mechanisms which were changing supply had no relation to any fundamental value here in that system either. So that was an example of supply changing mechanics that don't link with any fundamental drivers at all. I want to wrap up. We're getting to the end. We are with comments on two utility choices that are common, but I think are problematic. One is generic APY and staking rewards. Now, this will create rewards. This will attract demand in the short term because, oh my gosh, I want APY. Everyone comes in. But if these users aren't contributing to the growth of fundamental value in your system, your economy, you and your economy and your community are all going to pay for that. What's unfortunate is that everyone's kind of forced into a race into the bottom, because if this project's offering 5 million APY and you're offering 20%, well, people don't seem to be smart enough to work out that if something's too good to be true, well, it is. Look, maybe with everything that happened with Terra and Lipistau, people are a little bit more skeptical, but sometimes it's tricky not to have to compete for over generous inflationary bonuses. Rewards are fine. You just budget them. When you get a new product, limited discount, 1 month, 20% off or something. Yes, we're giving tokens away for free, but there's a strict budget. We're not committing to this being a never-ending program unless we have some kind of real way of making sure that the people who receive these tokens are genuinely creating value. Think back to those metrics I was talking about. Cost of client acquisition, lifetime value. If you know those things, well, then you can budget a rewards program better. The other one is using tokens as a medium of exchange. And this can be really risky if the economic activity is price sensitive to the token, and there's no sort of flexibility in the way that activity conducts itself to compensate for that. Or if you're using tokens as a revenue mechanism, and that revenue mechanism is then paying for your business operations, because people hate to remember this, but we still live in a fiat-dominated economy, and your business isn't paying its bills in your new shiny new token. It's paying its bills in fiat. So, if your revenues if you have decided that you want to create utility, by making your token a medium of exchange, and that feeds your revenue generation process, then you're stuck when the market goes south, because nobody will want your shiny new tokens, and you still have all these bills to pay. And that's why I recommend my projects to generate revenues through stable coins, and then that means that the users in your economy have to handle stable coins and not your token. So that looks like it's diminishing the demand case for your token. But in my opinion, the benefits outweigh the risks here. And I know that some investors have not been happy with designs of mine that have proposed that, and some people have other opinions. But this is why we're having an open conversation here. If you have a revenue process in stablecoin, you can use that to drive a buy and burn that acts on your native token, reducing supply and tying, because revenues tied to a fundamental process in your economy, then the scarcity of your tokens also tied to a fundamental process. Anyway, those are the 2 warnings I have, and that brings us to the end. And the 5 steps are there. Oops, a plug slipped in at the end. And that is the end of the presentation, and really happy to talk about anything and everything with you guys. So over to you, Max.
Awesome. Thanks a lot. And yeah, I mean, like I always love when I, see different perspective. And I think one really cool thing, and like Adrian had that question, is like, how can I find out what share of demand is focused on speculation? So obviously, I think what you showed really nicely is that you can mask utility. You can kind of claim you have utility, and you can install shady mechanisms so that some form of utility might be there. And I kind of like that framework now that we are looking at this, and we say, okay, look at is this pure speculation? If not, do they use mechanisms that kind of like SafeMoon, that kind of try to shadow or like try to claim utility where is none, and then go into like something like the market design. We often in this course talked about coordination games and basically coordination problems, public goods. So what's the real value of the economy? How's the value created? And that your token is basically an access to that, to that economy and market. And I think that's a really cool, like, small 3-step framework we can also apply, or everyone can apply now.
Yeah, I mean, it's very high level. The way this would play out in practice is you already have some kind of modeling tool or capability, and you would bring these questions to guide your choices about how you how you create your models, and then what metrics you pull out of your models. So it's, like I said, this is the point of having a theoretical lens and idea about how to approach this, that hopefully might help us structure our analysis and get more helpful things from it.
So more stuff in the chat. What is the token with the highest value from your point of view? Probably tied to real utility. I'd have an opinion on
let's
that.
See,
as well.
where is that highest value? I think Ethereum is it. I just think Ethereum's it. They've got fantastic network effects, a really strong user community. They're retrofitting. They're doing all sorts of really cool stuff. But that's it. You're kind of saying, what's the value of Linux? What's the value of an OS? It's a whole platform. I mean, there's an interesting question, and yeah, no, they are capturing. Ethereum has a value accrual mechanism that will benefit from everything that's built on top of it, because in order to execute a transaction on Ethereum, You need to pay in Ether. So it does have, Linux had no way of capturing the value of all the things that were going to be built on top of it, whereas Ethereum has it in its core design. So that's, I think that's where I'll go at the moment, as a simple answer. I don't think, I'm not to say that Ethereum's gonna rule the roost. There are other people coming up with new blockchains. Goldman Sachs, Microsoft, Deloitte have teamed up on Cantor, and it's really interesting. The white paper for their blockchain is sort of privacy, prioritizes privacy features instead of having all of this funky ZK tech stack bolted on to a public blockchain. They're building a blockchain that has privacy control, much closer to the core. So we'll end up with multiple blockchains, but fundamentally anything that's sort of like an open computer platform that has tokenomics that capture value from all computations is going to be huge.
Yeah, absolutely. So would you add, before we go to the next question, would you add value accrual as an essential dimension, under utility? Because I always would, yeah, do it.
This is interesting, right? What's the economic function of value accrual? What are you trying to do? What are you trying to achieve with value accrual? Now, if you want to have an asset that has a free price, or there's some sort of pricing mechanism that allows it to, that makes sense, because then that allows it to adjust in relation to other assets. But if you want to engineer something to build value over time, what are you trying to do with that? Are you trying to get investors on board? Are you trying to create some sort of reward mechanism or incentive that gets early users on board? Or does value accrual actually play a role in the economy? What are you trying to do? And the answer is, it's most of the time it's trying to buy community interest and investor interest. And I think one of the things I've spent a lot of some time thinking about is that this idea of making the token do everything sometimes can be very problematic, because if you're folding in the need to fundraise and bring in private investors with a token that is otherwise designed to have a utility role in an economy, that can warp the way it functions, right? And you have this utility token that users are meant to use in a special way, and all these investors who got in to make a financial return are selling it on the market, creating selling pressure, and that disrupts your fledgling economy. Why do we have these two things together? Well, the cynical answer is that if we make it an investment-only instrument, it looks like a security, and the regulatory overhead goes up, and the compliance overhead goes up. So to some extent, and also actually it's not always that cynical as well. We started out with Ether being a utility token with the utility token was sort of like the normal way to fundraise, but as the regulatory landscape becomes a bit more standardized and there's less opportunity for regulatory arbitrage, I think we should look at unbundling these features and say and think, okay, do we want this token to be a utility token and bundle in its function as a means of raising capital and as a way of onboarding an early community in with the features that we're designing to make it function as a utility token in this economy.
Cool. So I think we both could have an endless discussion here. Let's look at some. I think there's an interesting question I also asked myself. Are you familiar with the Solana ecosystem? So like Patrick asked, what do you think of Solana in terms of its mechanism for value flow throughout the network?
No, you'll have to coach me if it's innovative or different. I don't know. I haven't heard.
Yeah, so I'm also I'm not sure if I get the question. So it's about Solana.
There is something there. So there are some chains that are doing something slightly different. So this is the FAT. I don't know. Some people call it the FAT protocols thesis. So what some people are doing, what I was saying earlier, is that in the case of Ethereum, the first layer ones, all transaction activity, there's a mechanism that routes some value from all the transaction activity occurs down to the holders of ETH. But actually the dApps are creating value in the ecosystem as well. So why should block rewards or these base layer rewards only be paid out to validators and miners? So what some new layer one designs are doing is creating routing some of the base layer rewards and using them to reward the best performing projects at the application layer, and that sort of says, hey, we're all sharing in the wealth here. You guys are doing everybody a service by creating utility. And then, you could also design rewards for the most networked app. So that recognizes dApps that have sort of like more interconnectivity or structural importance in some kind of way. That's the only sort of shift in value sharing that I'm aware of in layer one designs. That's kind of interesting to think about.
Yeah, I'd also add probably like Canto and Radix, which are trying to reward the core developers directly in the transaction fees generated. So Ethereum, for example, relies on their protocol guild to keep core developers active and engaged and making it financially valuable. So some new designs are looking like, how can we integrate everyone that contributes like directly for like
I mean, duh. Yeah. you have to pay everybody. Everybody exactly. has to participate. People create value. That's a reasonable and sustainable claim. But this is the challenging question when we're tokenizing upfront is how much value are people creating, and how do we get that grant of tokens right? At least sort of like spread it out far enough so that value has a chance to catch up with all the tokens that have been emitted.
Yes, there was an interesting discussion going on. So basically, Adrian asked, how can I find out what share of demand is focused on speculation? And then Jakub, like he's a tokenomist as well, they're basically using Minsky to model these sessions, basically to model the economy. So what's your take on this?
Okay, well, two questions there. How do you look at the? Okay, no, I see why they're related. So my response first is to say, well, if you understand the structure of your economy, that gives you an understanding of what the fundamental drivers are and where to look to create a metric that can guide you to define, maybe imperfectly, but start getting some kind of handle on user activity that is characterized by utility interests versus those that are characterized by speculation interests. Now, regarding the use of Minsky, I had to be coached on this. I was really lucky to speak to another token economist, crazy background like MIT, Harvard. I don't know. I think the only thing he was missing was NASA, National Bureau of Economic Research, and he was modeling with Minsky as well. And Steve, the originator of the model, is divides opinion in the field of economics. But looking from what I can make out, this is sort of like it's like machinations. So you have these flow charts, but whereas machinations begins with an ontology or basic set of elements that are sort of very informed or lean towards game economics and faucets and sinks. I gather that Minsky has some slightly well, actually, I think it's much more flexible and open-ended. And I mean, yeah, or does it? Yeah, I'm watching you nod or shake your head. Yeah, Jakob, does it
No, I
have elements that are sort of strongly informed by economic concepts?
Yeah, I completely agree with you, and it's very similar to machinations, and the STP can be dividing. And normally, it's quite difficult to use Minsky, and it's not very stable. So we programmed some add-ons modules so that it can be used in micro, because it's more designed for the macroeconomic perspective and modeling of macroeconomics, while machinations is more for the user journey and the individual perspective and user personas. So we had to amend Minsky a little bit, add the Monte Carlo modeling modules and some analytic tools to it, but now it works pretty smoothly and it's quite versatile. What I like about it is the strict accounting structure with the godly tables. It prevents a lot of mistakes that a man can do for modeling, because it's a complex thing and everybody makes mistakes.
I saw that it has some sort of like accounting concepts in there that you can use, and you know, going back to my own background as a financial modeler, like accounting's great. It's I think it's a helpful instrument. This is actually something that's in my in tray for the remainder half of this year, is to start playing around with CAD and these simulation-based models. All my modeling to date has been in an Excel environment in that financial modeling style. So I'm not speaking from experience. I'm speaking just from my reflection and thinking at this point. I think that all these simulator flow type systems are great, but I would personally choose not to include the market process in the loop, because what I see a lot of tokenomics professionals, incredibly gifted, talented mathematical programmers, do is they put the DEX inside the loop of the whole economy and sort of like run these Monte Carlo simulations that include long-term price forecasts for the economy, and then come to some sort of view of saying, okay, we have a certain degree of confidence that our system isn't going to blow up. And I just think that's really, really risky. I would feel comfortable sort of creating a model of the internal economy, the utility economy, and then running exogenous price scenarios through that model, saying, okay, well, let's look back, let's see, what the 99th percentile of drops in market cap, market falls were, and let's run that event through our model of the economy. Or if you're going to include a DEX and automated markets in the loop, maybe do that on a very short term, again, scenario-driven basis. Okay, so let's see that the system's stable when we hit it with this price, and see how that goes. Let's put it at that price. That's how just my intuitions tell me, and the reading and studying that I've done, that trying to fold all of the markets into the loop to create a long-term forecast and to extract inferences that you're gonna, take comfort from, I think is incredibly risky. So I would use them in the manner I described.
Well, yeah, what I'm trying to search for is not stability, but instability. So when we do the Monte Carlo modeling, it helps us to identify the risk scenarios or the collapses of the system, the instabilities, and then when we can predict the collapse before it happens, which we can use for shorting some tokens, like we did with X Infinity, as you mentioned, or Terra Luna, using this modeling in Minsky. And when we do tokenomics for a client, it never can be completely stable, and there's still a lot of uncertainty. But you can identify some vectors of attack or some situation in which the system spirals, and then find a solution to see it coming and find a solution before it happens.
Yeah, that sounds great. I think Token Engineering Academy reposted a tweet sort of saying, you know, on this sort of topic of modeling style and modeling debate, that models are not for price prediction, they're for risk analysis. And what you described there is a risk analysis application. But
Absolutely.
I see a lot of again, people who are really respectable, really clever, creating these documents with price forecasts for the economy, very price centered, and I don't think that's appropriate in the client, given the uncertainty of the system, given the importance of that metric, and given the fact that we are, as consultants, we are in a position of understanding. The client's not going to have the statistics to create context and understand all the caveats with a measure. So, you know, personally, yeah, I would avoid doing that. But, you know, people who do otherwise have opinions of themselves. They're all, like I said, very respectable, decent people. So, you know, this is why we're having conversation in the open. So many people, so quiet. Was it that incomprehensible?
No, I think maybe it was the opposite. You know, like you know, I mean, Nate was sometimes so abstract that people had a lot of questions. Maybe you nailed it so well that nobody has questions.
Okay, all right. Thank you for helping me rest easier.
Also, I mean, this is now like I think the 5th tokenomics lecture, so I think people should start, you know, getting a framework out of all of this.
Cool.
I would say any more questions? Is there anything else in the chat? So yeah, we talked about the modeling. Solana is a difficult one. Okay, okay, so there's one more question about a bad example. But a bad example for a token or bad token utility?
Bad value, no value, let's say, yeah. Or like a hidden, maybe, let's say the utility, it seems to be a utility, but it was kind of, there was no utility, kind of promising, but there was not a real utility. How do you see the red flags?
Yeah, I mean, I tried to give, I've been so deep in all of this work that I actually haven't been going out there reading all the project papers to have a list of a bigger list of examples. But really just what I try and do, what I did for those videos that Max initially saw about, you know, the tokenomics that got me invited to give this conversation is to just draw these flow charts and think about the user journey. Why is this person buying? What are they doing? Okay, they get this APY. Where's the APY come from? And if you know, Olympus DAO is another example I have, but that was so complicated. I'm not sure I can reel it off the top of my head. But that was, you know, when people were explaining this to me the first time, I was there scratching my head and I was like, I don't understand what's going on here. They say it's worth $1, but it's people pay more for it, but they have enough value in the treasury to make it $1, and then it's paying this APY. And I certainly didn't get it just by looking at it. It wasn't as obvious a thing as SafeMoon, which, you know, admittedly, I would have still had to work out when I first looked at it. But it's just this persistence in not just taking, everything's going to be sold to you. Everything's going to be sold to you. What is it? Gosh, what's that? There's a decentralized exchange now that has some kind of that everybody's in on because they get a cut of the house rewards, and you know the fanfare is that their reward scheme is non-inflationary. Oh, okay, let's check. And if you know, I went through the steps and I said, well, they've contained that ordinary kind of inflation, but they've hidden it into something that may still come to inflate later on. And it's just having this sort of like I said, this skeptical and persistent mindset of really tracing all the steps and being unforgiving about saying, well, no, people are only going to, this is only going to have value if people demand it in the market, and people are only going to demand it in the market when other people demand it in the market. That's just hype. So I don't, yeah, it's sort of an open book. But it starts, I think, precisely because it can be confused. It starts with this commitment. How does this work? It's better to get a false no than a false yes in this situation. I think that's the way we want to calibrate our analysis.
Thank you.
Okay, let's wait. Let's see. No more questions. All right.
Okay, awesome. Thank you, everybody. Yeah, pleasure to take part, and awesome efforts to you, Max. Look how many weeks you've been doing it, and you've still got a full house here. So it's obviously going great. Congratulations. Oh, what are our thoughts on BRC? We got one. Thoughts on BRC20? I haven't been following that whole thing too closely, but I liked the purity of Bitcoin. I like the purity of the original case of Bitcoin. We've got Ethereum to do everything else. If we start throwing noise into the Bitcoin, we lose the purity that creates its clearest value case, in my opinion. I just think I do think it's a bit dumb, and to be, you know, just reproducing all the stupid mistakes that we already went through again for the lulz. I find it a little irritating, to be honest. It doesn't make us look good, in my opinion. Us, you know, it's a distributed, decentralized community. What are we going to do? Do you think Bitcoin will one day be? Oh, here they come in thick and fast now. Sorry, Patrick. I don't know. Like, that was my knee-jerk reaction. My attention's on other things. There may be cool things that are happening, but personally, it's yeah, I really enjoyed the purity of Bitcoin, and what advantage does the Bitcoin network have as a computing platform if that all this effort's already going into Ethereum? But that's me, and like I said, I haven't been going into the detail of every project. Do I think Bitcoin will one day be rendered outdated? Who knows? For the moment, in that sort of like pure state where proof of work provides sort of like some ultimate guarantee of digital scarcity, and everyone is rallied behind it. You know, there are all these first mover advantages and network effects get in its favor. So, you know, something else could happen, of course, but I don't know that it's I don't have a view that it's inevitable that it will be superseded by something else, unless, you know, we're talking about, you know, the distant future where we're all, you know, satellites or orbiting stars having a simulation hallucination for an experience or something, you know. Yeah, no strong views either way. So anything that makes any development that makes Bitcoin more transactable is a go. I was understanding the BRC20 token fad as some, you know, trying to create all these meme coins out of an artifact in the Bitcoin source code that wasn't intended to be used that way. That was my understanding and my reaction to the thing. If they're building things that genuinely improve the liquidity and lower transaction fees, that aligns with Bitcoin's core identity as I see it.
Also not a fan. Why? I think. But I think that's our industry. Just whenever we run out of innovative ideas, we just think like, okay, meme coins is now the thing, or just ordinals or whatever. And that's like,
yeah. There's I think you can still find it online. EY did a great conference in London about 2 months ago, and they were revealing all the blockchain products that they've been working on, geared to sort of like tokenizing carbon, tracking supply chains, having multiple unrelated parties collaborate. This stuff was absolutely fascinating to me, and really reassuring that companies are gradually onboarding. This is probably going to be a decade-long change in terms of seeing. But when it's adopted, there might not be any street cred for you, because nobody's going to know that it runs on blockchain. So people are just going to think that you got lost in some fad 10 years ago that died when it ends up running the world economy. I don't know.
The tokenomics idiots rent the one way.
And then we're hopefully we're doing all right by ourselves by that point. But yeah, it's all fascinating.
Awesome. I would say, looking at the time, great end statement. Like, we have the tools to build something amazing. Let's do it, and let's not get lost in some meme coin fads. And Pepe is not going to save the world. Pretty sure about that.
Thank you so much, everybody. And thank you, Max, for this great initiative, and look forward to see how it continues to evolve and bear fruit.
Sweet. Cheers, everyone. Bye-bye.
Bye-bye.